Kenya's trade volumes rose nearly 5% to 1.9 trillion shillings in 2012 on the back of sales from tea, horticulture and coffee. The growth story is replicated in most African countries and has set the stage for banks to take up opportunities to fund investors in the import and export business.
The reason that banks are becoming more interested in trade is twofold. I think the first instance is because the banks themselves have become more educated and more sophisticated in their delivery of trade solutions to African trade clients. In the past, banks did a certain type of lending which basically took a view on the net asset value of a company's business, and that's what drove the lending decision. But now banks are understanding that in order to assess trade and support trade clients more effectively, you need to be able to tailor products that suit a particular company's instances, and you therefore can't just take a balance sheet view. You need to tailor your financing solution to suit the trade flow, the market that the goods are coming from, the markets that they're being sold into, and the counterparties who are actually facilitating the trade.
What we see now is that there's more and more competition between banks. So clients can pick and choose, and they can negotiate, and banks are now looking for alternatives. And we are a very nice alternative, because when a bank gives a loan, we can take the risk on the client, and if the loan is not paid back after a certain time, we will pay the bank, and we will help them in the collection.
The looming Eurozone crisis has put Kenyan exports under pressure, mainly due to low consumption, especially for commodities that are considered a luxury, such as flowers.
If you're, however, an exporter of steel or products into Europe, because of the recession, two things happen. There's less demand, prices get squeezed in Europe, and that feeds all the way back to you as an exporter. So a lot of the exporters, for instance, are now looking to Africa. I'm not remotely going to suggest dumping product, but they are looking desperately to find outlets for their product. Now that's good and bad for Africa. It's good that prices therefore should be more competitive as these products come in, but it's not going to help Africa develop its own industries.
What we find and why trade remains and becomes more important is in times of economic downturn, a lot of companies tend to defer the capital investment projects, and therefore services for advisory services become limited, or they're scaled back by our clients. And this creates a financing gap. From the bank's perspective, the opportunities become limited because all the clients will now just continue on their day-to-day trading activities and decide to lay aside the big, more expensive project finance type investments. So the bank steps in. If we are providing trade, we will provide trade and support those clients through both good and bad economic times, when our colleagues in other business divisions within the bank, for example the project financing areas, have to scale back on the business because their clients simply aren't taking any huge investment decisions.
Strategic location of the Mombasa port acts as a gateway into East Africa's landlocked countries, making it a major catalyst for trade. Uganda, which accounts for nearly 70% of all transit goods from the Kenyan coast, is the country's leading trading partner. However, more needs to be done to develop the infrastructure in order to boost the competitiveness of the region.
Mombasa is playing a really important role for the countries like Uganda, Rwanda, Burundi, and I think Kenya is important in terms of the trade because of the port. So now I think if we want to expand this whole universe of warehouse financing, I think it is needed to build the warehouses inside of the country. So not only just Mombasa, but the inside of the countries, or maybe other countries, Uganda, Rwanda, Burundi, if they have warehouses, then their business opportunities increases. So there are couple of challenges, and I think one is that, as you said, infrastructure is not enough. And then the case of, for example, Ethiopia, it's a little bit different case, but the government is building warehouses. They are taking the initiatives.
The biggest international traders will have the clout and the power to have storage inland, and the guy that controls the storage often controls the price. The really big guys can float much bigger ships and discharge in 2, 3, 4 ports. And I'm afraid I can see the smaller, medium-sized importer and trader having tougher and tougher times. because not only is he going to be squeezed on the price that he's going to be buying at from the world market, he's going to be squeezed by the banks in what they're prepared to lend, in effect almost a non-investment grade company, and the challenges ahead at that level are not good. So there's going to be more and more rationalization and consolidation around the world.
The IFC, which is the lending arm of the World Bank, has set aside funds to finance warehouse development, with a major focus on Africa. The continent is still struggling with storage facilities for its commodities.
We've done market study back in 2009, and we actually did a market study for 15 countries in Africa, and we understand that there's a potential growth of about 11 billion US dollars in the space of warehouse financing. So our program is sounds still small, but then I think this is a baby step. We would like to support Africa in the area of warehouse financing. So we are making some efforts. For example, one is that we just published more like a textbook of warehouse financing, how to do warehouse financing, and we'd like to use this textbook to facilitate the training programs.
As commercial banks craft innovative products for their trade clients, mitigating risk is a top priority. But availability of information about the clients in order to determine their credit worthiness has proven to be a challenge in some countries.
When we talk about Africa, I would say there's one country where we feel really comfortable because we have very good information sources, very competent people, that's Kenya. Outside Kenya, we can do business, but with the help of our client in Uganda, in Tanzania. Rwanda probably could work as well. Outside that, it becomes very, very difficult because we don't have, the legal background is not there. In many countries in Western Europe, for instance, or in the US, companies have to file their financials. That means, and these financials are quite often publicly available.
From the bank's point of view, it needs to become more innovative if it can because of Basel III. And the Basel III, as we know, requires higher capital to be held on balance sheets. It requires a greater range of risk mitigants. And obviously one of those risk mitigants is how it manages its collateral on the ground. I've mentioned legally through pledges, proper insurance, maybe it's even syndicating its loan, having collateral management. These are all different risk mitigants that allow the balance sheet cover to be reduced.
For entrepreneurs, before considering approaching a bank to fund your trade venture, the following salient issues are a worthy consideration.
Is there a demand in the market for the commodity that is being imported? What is the price risk that the bank would have to assume via the client? Have they hedged if it's a commodity that is exposed to very high levels of volatility? And if the import is in foreign currency but sales are in local currency, and there's a 90-day lag before the commodity is converted back into cash, how are they mitigating the foreign exchange movement risk again? So again, banks would have to look at all these series of risk